audit, litigation, slump cell, merger, demerger, and on trade remedies. I would like to welcome Mr. T.B. Chatterjee, our chairperson, Indirect Taxes Committee, the Bengal Chamber of Commerce and Industry, and partnered TCN Global Economic Advisory Services LLP. I request Mr. Chatterjee to deliver the welcome address and take the first technical session on GST, slump cell, merger, demerger, integrative scheme to take the session forward.
Thank you, Sarvani. It is certainly our pleasure to meet again. I think we had our last workshop about 2 months back, and then we thought we should have our workshops on a totally different issues, which are not normally discussed in workshops like these. And that is why I suggested, let us discuss the impact of GST on various other areas. But before doing that, I would like to say that this is our third workshops in this year, 21-22. And we have two eminent speakers in this webinar. Sri M.S. Mani, who is the partner of Deloitte, Mumbai, and he is a well-researched person in India in the indirect taxations. You can understand he's the head of the Mumbai area where Deloitte has got so many large companies. We have also, and we are really fortunate to have Mr. N.C. Guria, who is the Joint Commissioner, Commercial Taxes, Government of West Bengal. I have personally requested him as a chairman of this chamber of Indirect Tax Committee to come and personally share his views about the audit related matters, which is very, very important. So GST audit has started. You know, you have been getting various memos, directions from the GST authority for their departmental audit. And we have to know how we can avoid litigations. So I'll be requesting Narayan sir to share his views. And we have all large companies, structured companies, well-established companies. So they would like to know from you in your how they can provide all the details with regard to the audit and can have a very clean report from the department without compromising the legal provisions of the Act. So, and Mr. Mani will be talking about the relevant issues which we had handled in the last 4 years of GST. Few days back, I circulated an article which was published in Financial Express about the GST look forward and what had happened in the GST in the last 4 years and what we are expecting in the next 4 years. We had really made a very researched article and was published by the Bengal Chamber of Commerce and Industry. And you will be very happy to note that I have got a letter from the ministry acknowledging our contributions towards providing various issues, towards highlighting various issues, as well as we had given how these issues can be sorted out. So we have got a letter from the industry ministry explaining that they have considered our views and they will discuss this matter very soon in the GST Council. So please do keep in touch with the chamber regularly. And I have, as I always request to all of you, that if you have any issue, then please come back to us we have the access with the state GST department, as well as we have the access to the Ministry of Finance, Ministry of Commerce directly, and we can handle your issues. We are at present, we are handling 5 different issues of our members, and we are contacting the department both in the central and states. So be proactive with the chamber, join in our various workshops wherein we are inviting all these eminent personalities to really express their views on various difficult subjects. So welcome to all of you and good afternoon to all of you once again. And I have a very limited deliberations, and those deliberations are basically limited in the areas of a certain type of transactions. No, in business reconstructions is very, very important. It depends on the market. It depends on the business scenario. It is not really a financial decisions. Simply a financial decisions. It is linked with the market. It is linked with the profitability. It is linked with many other areas. So we normally take the help of various reconstruction mechanisms in our business. Now, today's workshop is not really to discuss what are those, because I presume that you know those reconstruction issues very clearly, but still we'll discuss and we'll say when it happens. So you know the subject, and then we'll discuss about its impact on GST. Our main intention is to really touch upon those important issues which are not normally discussed at common parlance or common forum like this. So we are going to pick up those areas. Now, in business, reconstruction is necessary for many business reasons. I will first start with one, say for example, demerger. Normally, in case of Reliance, you must have heard that there is always a talk that oil to consumer business, they are going to demerge. Now, when this demerge is necessary, and I'll talk about the GST impact in the next deliberations. So when demerger is necessary, is it just a wish, or it is a market requirement? I'll give you some example. Say for example, you have five specific departments or 5 specific issues. For example, I worked in a Voltas India Limited. It's a very large company, and it had around 20 plus, if I remember correctly, divisions. Now, it is not that all the divisions will run okay, depending on the market. Say it has a chemical divisions, engineering divisions, appliances divisions, air conditioning divisions. So many departments are there. Mining divisions, all these things. Then pharmaceutical divisions, food products divisions, all these things. Now, it is not that all the departments will run in the same manner. It is not right to assume that all divisions will have a same growth rate, same profitability, same percentage, etc., etc. So if you have, say for example, 5 specific divisions, you might find one specific division is not doing well. I don't want to give any specific example, but you know in Kolkata, is a very large consumer product divisions. But one particular divisions, these are all consolidated. That means one company. And the company is doing exceedingly well in terms of turnover, in terms of profitability. If you see the dividend payout ratio, fantastic. It is one of the larger dividend paying company. But in spite of that, the business is not taking, the growth is not there in the valuation of the company. If you see the market cap 3 years back, and if you see market cap today, you will hardly find any difference. But you can, it is a cash-rich company. You know, in business scenario, there are cash-rich companies, there is a star mark and all this. The BCG matrix, you know, there are 4 quantas of the matrix, and one matrix is called cash-rich. Now the question is that why? Because unfortunately or fortunately, they have few divisions on which public sentiment is negative. And you know, the valuations of a company depends on public image, public sentiment, governance, profitability. It is not their only profitability. So as a result, it finds that because of few divisions or few departments, specific product departments, you can call it as a cost center, the valuation of the entire business is being affected. So how to get out and increase the value? That is the most important. The shareholders or all the stakeholders, they want that the valuation of the company should increase. It will not only benefit the promoters, it will also benefit to the public. For example, the valuation of Reliance is around 13 lakh crores. Now, if I tell you the valuation of Apple is almost equal to or 50% of the India's GDP. India's GDP is around 220 lakh crores rupees. If you consider it's as in $2.85 trillion. Now, valuation is very, very important. If the sentiment, if the company deals with any negative product, although the product is doing exceedingly well in terms of making profit, but business as a whole sentiment is weak. So in that case, what will you do? Subject to the approval of various areas, you can think that the divisions which are not doing well or which have some negative sentiment, you separate it from the whole company and let it be wholly owned subsidiary. So like that, demerger takes place. Mind that merger, demerger, spin-off, slump sales are all done for only one reason. Please understand, only one reason, that the cost comes down and profitability of the merged entity as well as the demerged entity, the value increases. Now, say for example, Reliance is thinking to separate its oil business from Reliance Industries. It will be another company. The basic intention of that, you have to understand that the basic intention of this is that the refining business has its own deficiencies. Now, Reliance is estimating that its refining business will come down after some time because of the environment, because of so many solar powers are coming, electric vehicles are coming. So it is better if we can separate this particular unit from the total unit of the company, wherein there is a industrial growth, industry growth, profitability growth, And if you consider the value of these two companies, you will find it will exceed the total value as on date. Or you can take one promoter, outside promoter, into the merged entity, demerged entity. Say, for example, oil business is separated and other than oil business is kept under Reliance. Now they can think to bring Saudi Aramco as a partner in the oil business. But if they have to bring today, they have to give share of their other businesses also. So there are many business conditions under which the industry has to think for demerger. So what happens in a demerger? From one company, you are getting the say of two different companies or three different companies. It is demerged from the existing one. This I will discuss about the GST part because our job is to basic. Now, in case of slump sale, in the GST law, there is no specific definition of slump sale. So you have to take the help of Income Tax Act. Now, what is slump sale? In a slump sale, a particular business assets or particular departments is being sold to another one with assets and liabilities without identifying the value of the assets separately. Say, for example, you have one divisions. And one division, say for you have a chemical divisions. In a chemical divisions, you have your assets, you have your liabilities, and you have transferred without identifying the value of assets and liabilities separately. You are transferring that assets, or you can say you can selling these assets with locks, stocks, and barrel. This is a very important sentence. With locks, stocks, and barrel. At a lump sum considerations, that is called the slump sale. Why slump sale? Why people do not buy the company? You see, this is also business conditions. Suppose you have identified a company that one particular divisions is not doing well. But you are very, very confident about this. Lakshmi Mittal, you must have heard his name. This is a Sikh company. He has become a big because of buying Sikh companies. He does not have any greenfield company. So you find a particular divisions is not doing well, but you have a strong perceptions about these divisions and you feel that you can turn it down. Now, why you do not want to buy the company? Because buying the company means buying the liabilities, buying the hidden liabilities. So instead of buying the company or instead of buying the shares of that company, it is better you buy the divisions and with locks, stocks, barrels. So therefore at a lump sum price. So you're buying basically the assets and liabilities of a particular company. And that is called slump sale. Now you can ask me a question that what would be its impact in GST? Will it be considered as a goods? If it is not considered as a goods, you know the definition of the service is very peculiar, that whatever not fall under the goods, that will come under service, then will it come under service? Say for example, if it is a spin-off operations of say 200 crores or 300 crores lump sum, then whether the GST will be applicable on 300 crores. What about the ITC accumulated in that company, old company, whether the ITC can be transferred to the new company. Are you hearing mine? Sarvani? Sarvani?
Yes, sir. Yes, sir.
Can you hear me?
Yes, yes.
Yes, sir, I can hear you.
Because it is showing, the computer is showing that install server not responding.
No, sir. No, sir. It's perfect.
Okay, so please, because it is giving a message.
Okay.
So you are not very comfortable to buy the company. You are comfortable to buy a particular divisions with assets and liabilities, whatever is written. In that case, slump sale will apply. So in case of a slump sale, you have to know whether GST will apply on the total value of the considerations. This will be applicable, and in that case, GST will applicable as applicable on services. What about the accumulated credit of the company? Whether the divisional credit can be transferred. Suppose they are maintaining one particular GSTN for all the divisions, how ITC will be transferred, whether any ITC is likely to be reverted by the transferor company. In every amalgamation merger, you will find two companies. One is transferring, that is called transferor company. Another is getting the assets, it's called transferee company. Now, what about transferor company? So whether transferor company has to reverse the credit which they had taken on ITC. So these are many GST related matter, and you can appreciate that the liability will be in crores. Will be in crores. It is not a single transactions, just 200 or 2 lakhs or 3 lakhs. Normally, we have seen average transaction value will be 100 to 200 crores. So if you have to pay 18% on 200 crores, probably you have to close the business. So that's why we thought, let us discuss these issues in threadbare and how you can really take into account. Now, first we have discussed the demerger. That means one division is going out from the company and going to the another company with assets and liabilities, specifying the price, with specific price is there for assets, liabilities, and purchase consideration is fixed. And you all know these are all done by a scheme of arrangement, that is the merger scheme or demerger scheme. One scheme is prepared under which all these details are written, that what assets are going, what liabilities are going, what about the employees' employment related issues, all these things. This is called scheme of arrangement. Previously, the scheme of arrangement used to be approved by the High Court, but this approval process has now been shifted to the National Company Law Tribunal. So for every merger or every demerger or amalgamation, there has to be a very clear scheme of arrangement under which all these transfer details, who is taking, who is giving, all these details are, and it has to be approved by the shareholders. Now, from GST point of view, you have a lot of responsibility while preparing this scheme of arrangement. You have a lot of responsibility, and there you cannot make any mistake, because it will be approved by the competent authority. Once it is approved, it will be considered as valid document and everybody will have to accept it. Nobody, no tax authority or quasi-judicial can raise any question on scheme of arrangement. Please note down that scheme of arrangement has to be drafted properly, wherein you must explain what you are doing and what liability you are taking, what assets you are taking, what employees' responsibility are taking, all these details. And if you have the accumulated credit, that is ITC, is to what extent the ITC you are transferring to the transferring company. That amount has to be specified so that there will not be any problem from the departmental point of view or audit point of view about getting credit by the transferring company. I have already told there are two sides. One is transferor, another transfer. Now, in case of, let us first discuss whether GST is applicable on slump sale. Now, before going to that, you have to understand that first identify, is it a goods? Now, you must be knowing that in a slump sale, as I have already explained, there is no specific assets and liabilities. And not only that, the asset might also cover the immovable properties which are outside the purview of GST. So far taxation is concerned. So you cannot say that it is a goods. But unfortunately, that if you do, the moment you say goods, the answer is, question is it a service? Is it a business? If you see section 217D, wherein business has been defined, and business says the supply or acquisition of goods, including capital goods or services. That means in terms of section 217E, it is a business. It comes under business because it clearly says supply or acquisition of goods, including capital goods and services. So there are capital goods, and accordingly, it complies the definitions of the business. Now the question is that, is it a goods or is it a service? Goods as defined under the GST law means every kind of movable property other than money and securities, but includes actionable claim, growing, etc., etc. That means it has to be a movable property. But in case of slump sale, the immovable property is also there. At the same time, liabilities are also there. You are transferring assets and liabilities. And assets does not have any specific value. Liabilities are not also a specific value. So the companies, I will tell you the background of this term slump sale, which has not been recognized by the GST Act, but recognized by the Income Tax Act. The most of the major companies, they used to take the help of slump sale while selling. Because in the Income Tax Act, for slump sale, the cost was not defined. So if a particular item is transferred without having its cost, then it will be considered as a capital receipt. And capital receipt was considered to be tax exempted. I have handled many such cases wherein we lost the case in the assessing officer, but in the CIT appeal or CV or tribunal, we got the relief. Because in case of slump sale, there is no value asset-wise or liability-wise, and there is no cost. You are transferring a particular asset liabilities at a value of 1 billion. Now, in the Income Tax Act, there is no definition what is the cost of a slump sale. So people used to get the advantage of that, and they say it is a slump sale instead of demerger. And they used to get the benefit in terms of exempted income, because all the courts have opined that slump sale profit is a capital receipt, and you all know under the Income Tax Act, no tax is payable on capital receipt. But subsequently, the government has changed the definitions and made a specific provisions about the cost of the slump sale. They have said that the depreciated value of the transferor company will be deemed to be considered as the value, and therefore the difference between the depreciated value of the assets and the transferred value less liability will be considered as the profit, and it is now under capital gain tax. So today slump sale you will not find very common, but still people are going because some of the acquirer, they are not interested to buy the company to avoid future liabilities. So now coming back to that, so it is not a goods because it is not movable. At the same time, liabilities are also being transferred. Then it has to come under service. Because the definition of the service, all of you know, that which are not goods, that will come under service. The definition of service under GST is very wide and covers anything other than goods. Accordingly, slump sale may fall under the purview of service. Having said that, you have to recall the exemption notifications. Mind that the slump sale, as per law, is a providing of service. It also comes within the square definitions of the business, so there is no dispute. But there is an exemption notifications, notification number 12 by 2017, dated 28/6/17. I'll repeat, 12 by 2017, dated 28 June 2017, under which the exemption for service by way of transfer of a going concern as a whole or independent part is exempted from taxation. That means two conditions are to be there. It has to be a going concern. That means the assets liability transferring the company should continue its manufacturing process. So under notification number 12 by 2017, the slump sale, the transfer of assets and liabilities as a slump sale will be considered as a service, but there may not be any GST implications because of specific notifications. So one thing is very clear, that slump sale, the value of slump sale will not attract any GST. But now the question is that, hello?
Please mute yourself.
Sarvani, will you silence them?
Please mute yourself.
Please silence them from your end itself. So next is that, okay, the transaction is exempted from the GST. Okay, fine. Now, how I will transfer this accumulated credit to the transferring company in respect of the unit which you are transferring in case of a slump sale? Yes, you can transfer it, and that is under section 18(3) of the CGST Act. How will you transfer? You have to calculate what is the asset value as per books, what is the total asset value of in the books, And what is the total asset value you are transferring? Mind that asset will include fixed assets, whether you have taken ITC or not. That means the assets value in the books of the transferor company divided by total assets of the company into total accumulated ITC. This amount is eligible to be transferred to the transferee company, for which the transferor company should file ITC 02 online basis, which will be accepted by the transferee company, and by this way the credit can be transferred. Now this we have understood that how credit will be transferred. Now the question is that you are supplying services, which is a service but exempted service. In that case, what you have to do? What documents you have to do? According to us, since it is an exempted, because of 12/2017 notifications, you are transferring an exempted item to the transferee company, and in that case, you have to raise bill of supply. And when you are raising bill of supply, then you have to reverse the ITC also, because you know in a exempted item, you cannot, since you do not pay tax, you cannot take any ITC also. So the amount of ITC transferred to the transferee company has to be reverted in the books of the transferor company. This is very important. That means the main transaction is exempted from taxations because of notifications. If the notification is withdrawn tomorrow, then all these merger, amalgamation, and not amalgamations, demerger, spin-off, and slump sale will come within the purview of services, and it will be subject to payment of GST. So when you draw the value, you must keep into account that this is a cost. Secondly, even today it's exempted, but you have a lot of responsibilities. You have to see that this amount is transferred to the transferee company, which will be proportionate to the value of the assets transferred. Third, ITC 02 has to be filed. And then in the case of a transferee company, they have to accept the ITC 02 so that they get the credit. And at the same time, since the goods are being transferred without payment of duty, the ITC which you have otherwise taken on those goods are to be reverted. So there are 5 or 6 compliances are very important. Mind that in case of slump sale, no deed of variation or any scheme of arrangement is prepared. One document is prepared, is called BTA. This is a new concept, that business transfer agreement. I know you people are handling taxations, finance, but these are also equally important to know that where you need scheme of arrangement and where you need BTA. Since this in case of slump sale, it does not go through the court, it does not go through the NCLT. You have to prepare a business transfer agreement. And in that business transfer agreement, the GST related matter, including contingent liabilities, has to be very clearly mentioned. So this is one. And so another point we have noted down, that in case of slump sale, no court approval or no NCLT approval is necessary. It is only to be made between agreement between A and B, that means transferor and transferee, for which one BTA is executed. But in case of a merger amalgamation, I'm not saying takeover, merger amalgamations. Yes, there will be necessity to have scheme of arrangement which needs to be approved. And you as an indirect tax expert or finance expert, you have to see how GST has been dealt with in the business transfer agreement or in the scheme of arrangement. The scheme has to be very clearly mentioned that what is your ITC credit, what reversal you have to do, what are the liabilities or contingents which you are transferring, what are the liabilities you are not taking. All these details are to be there in the scheme of arrangement, and that is a very important. Once this is approved, because it is a very important, once it is approved and by the honorable court, then it becomes a law of the country. Nobody can refute. So these are all very important things which I thought I should discuss with all of you. And takeover is little different. You know, takeover does, there is no GST related matter is involved. Takeover normally taking over a company by way of acquiring the shares. So once you acquire the shares of a company, it can come under takeover. So it is basically transferring shares from one hand to another hand. So they are not buying the business. They are, somebody is buying the company. So in that case, other than capital gain tax and STT and others, no GST is applicable. So GST is not applicable in case of slump sale at present because of 12/2000, but it is actually a taxable event. But it is not available because of the exemption notifications. Valuations is very clear, and you know that you have to look into the valuation rules, because when you raise the bill of supply, what value would you put? So you know that you have to go through the valuations rules, and there say you will find you have to give the value which has the reasonable value in the market, because it is very difficult. You are not specifying the value on a case-to-case basis, A, B, C, D, 5 units. So not like that you are giving a value as whole. So therefore you need to have a proper fair valuations. Fair valuations may not tally with the transfer price or at what price you are transferring the divisions. They may not tally with that. But so far GST is concerned, when you are raising the bill of supply, you have to give the value which is a market value of that particular divisions which you are transferring to slump sale. So value and your slump sale value may not apply on GST law, and GST law has specified what is valuations. So if it is transferred from you by email on these particular issues regarding. So we have discussed in detail about the slump sale, demerger and turnover. Takeover. In case of takeover, there is no applicability of the GST. Only takeover code will apply, and SEBI approval will be applied, and all the open offer, etc. But from GST point of view, there is no compliance at all. Only once the directors change, name of the directors, etc., those informations has to go to the GST department. But so far taxation is concerned, I do not find any such issue. So with this, I conclude my deliberations, because any deliberations beyond 35 minutes becomes a little boring. So if you have any question, I'll be very happy to answer those questions specifically. And in future also, whenever you have any issue, you can freely contact Sarvani or me, and we will try our best to help you and to give you the right answer. If not, we'll contact with the department and try to get their considered opinion. With this, I'll return back to Sarvani for the second technical sessions, which will be taken by Mr. M.S. Mani. He is also co-chairperson of our committee, and he is also a partner of Deloitte India. He will discuss 4 years of GST, how it fared, and look back with major issues which are still open. Friends, you might be seeing him very regularly in City, BNN, and all these news channels. This is a high time for you to ask your difficult question. And he is the person who is handling the entire Mumbai region of Deloitte. So he is interacting with various types of companies. So this is a very high opportunity for you to interact with him, to ask questions on that. And he is he operates from the Mumbai. So with this, I'll request Sarvani to take the proceeding further. Thank you.
Thank you, sir. Any questions to Mr. Chatterjee?
You can send your questions by email also, which will answer.
You can write in the chat box also. So during the question and answer session, the speakers will take up the questions. If there are any questions to Mr. Chatterjee, we will have 15 minutes question and answer session at the end, so he can answer at that time also. So with this, I thank you, sir, and I welcome Mr. Mani to take the next technical session forward on GST, how it fared in last 4 years, what are the major issues and which are still open.
Thank you, Sarvani. I hope you can hear me.
Yes, sir, I can hear you.
Okay, you may not be able to see me because I have a problem with my laptop camera. So you may be seeing some light instead of, me, although I have turned on the camera.
Okay.
So thank you, Sarvani. Thank you, Mr. Chatterjee, for your kind words.
Thank you, sir, for your coming and taking this important sessions. We have all the companies, good companies with us, large companies, manufacturing companies. They will be highly benefited with your deliberations, sir. Thank you very much, sir. Please carry forward.
Yeah, thank you very much. So without spending too much time, I will just proceed because we have, I think now 30 minutes to deliberate on 4 years of GST. Now, this is a topic, as all of you would be aware, where we can actually spend, maybe 3 hours. We can spend the whole day. We can have it a 2-day session deliberating just on 4 years of GST. It has been such an eventful transition. So what I will do is I will speak on a few things which many of us may or may not have realized. And these are things which typically come up every time we start discussing, GST, because large part of the media today reports every month on the GST collections. But when there is a collection, what is going on behind the collection? So let us take a step, back and have a look at it. So I will just share a slide. Give me 1 minute. So Sarvani, I think you'll have to enable me to share a slide deck because it says I'm disabled from sharing my slide.
Okay. Yeah, you can share the screen now.
Yeah, thanks. I hope all of you can see my screen now.
Yeah, we can see your screen.
Okay, let me just put it on full screen. Okay, I hope this is visible to everyone.
Yeah,
Sarvani,
it's
Yes,
visible.
yes.
Thank you. So I will just touch upon some of the things that we have seen in terms of 4 years of GST. And the slide deck is more in order to remind all of us of where we started and where we seem to be, headed. So in 2007, in the Union Budget, we first heard a mention of GST. Now, 2007 was, according to me, a very, very challenging time to introduce GST because many of you who have been dealing with indirect taxes as long as I have been dealing with indirect taxes for the past 20 years, will remember that it was only in 2004-05 that we moved from sales tax to VAT. And when we moved from sales tax to VAT, majority of the states moved in 2005. But there were some states like UP and Tamil Nadu, which did not want to move from sales tax to VAT in 2005. So they took time till 2007 to VAT from sales tax. And therefore, it was a pretty good move on the part of the government. I would say very, very ambitious. That in 2007 itself, they started saying that, look, now that we have moved from sales tax to VAT, let's plan the next stage transition, which is to GST. So 2007 Union Budget was the first where there was a statement of intention mentioned on movement to GST. Now the question was, when the desire to move to GST was expressed, there was a lot of opposition from states. And I'm refreshing some of these topics now, although many of you will be aware of this. This is not to convert a tax session to a history session. This is just to get a perspective of what I'm going to say maybe after 10 minutes so that you can link up the two. Several of the states had an objection to moving to GST for two reasons. One, the states had a sovereign right to collect certain taxes, and they felt that some of their rights were being taken away by the center. Equally, the states were dependent on the taxes collected from VAT in order to finance their development expenditure. So what happens to the development expenditure? Both of these were put up by the states. At that point of time, there was an empowered committee of state finance ministers, and they deliberated on this many, many times. The momentum on GST came somewhere in 2016, where for the first time, the center engaged the states in a constructive dialogue. And broadly speaking, what the center told the states was, look, first, you're concerned in respect of losing your sovereignty to levy taxes. You're concerned on the fact that your powers are going to be reduced. We are going to address this by giving you more powers. So while we are taking away your exclusive power to tax goods sold within the state, we are now going to give you the power to tax services, which until then was a prerogative of the central government. So this was called a grand bargain. That was a terminology many people used at that point of time. And they said there is a grand bargain between the center and the states, where the states will cede the power to tax goods sold within the state to the center, which was earlier their exclusive domain. And in lieu thereof, the center will cede the power to tax services, which earlier was the exclusive domain of the center. So this grand bargain took care of the sovereignty aspect of, or the states feeling that they are losing their powers to levy taxes. Next issue, as I said, was how do the states finance their development expenditure? What do they do? For this, what the center did is they assured the states that they would finance their shortfall, if any, from GST compared to a base year of 2015-16 for the next 5 years after GST introduction. And they said, we will levy a tax, compensation cess, and we will pay all of you for whatever is your deficit. So effectively, the central government became the underwriter of the state finances for 5 years after GST introduction. They under that contract. Similar to an insurance company when they take on a risk they don't want to carry the risk in their books. What do? They underwrite that risk with a reinsurer. That is exactly what happened in this respect as well. Now, because of the previous experience in relation to central sales tax implementation, recollect for a very long time, the rate of CA with concessional forms was 4%, brought down to 3% and percent. This had happened in early 2000. Equally, the central government had promised to the state governments that they would make up for the deficit. But there were some issues in making up the deficit. On account of that, the states insisted that the center record its underwriting guarantee to fund the deficits in the form of a central legislation. So that is why we now have an act called Compensation Cess Act 2017, which is passed by Parliament. And since it is an act passed by Parliament, neither the center nor the states can go against it. If anyone wants to defy that act, they have to go to Supreme Court and plead a case over there. So this was the genesis of the Compensation Cess Act. With this bargain being in place, both on the sovereignty and on the collections, states agreed to come on board. There were several GST Council meetings held in 2016. Subsequent to that, in 2016 November, many of you will recollect, we had a demonetization. So because of demonetization and because of the difficulties that many states faced, for a period of 3 or 4 months, the GST Council meetings were at a standstill. After that, again, the pace picked up and we got into GST in 2017. Now, this background is something which, as I said before, the objective was not to convert this to a lesson in fiscal history. The objective was, in the last few years, after GST has been implemented, it is stable today. Many of the IT challenges are no longer there. Sometimes we forget how it was just 4 years back. We are not talking of something that happened 40 years back. We are talking of just 4 years back. And 4 years back, this was the prevailing situation. Let us take a look at what kind of taxes we had. And I will keep this very brief and very short. The idea was, in the pre-GST scenario, a manufacturer of goods had to grapple with a central excise duty and had to grapple with a VAT in every state where he sold his goods. In addition, some states also levied an octroi or entry tax. And all manufacturers of goods had to grapple with these. Service providers, on the other hand, had to grapple only with the service tax, which was a central tax, which had one registration pan-India and where the return filing was just twice a year. So from there, we moved to GST. And in GST, at the beginning itself, it was decided that we will be working initially on a 4-rate slab. We will be working on a 5, 12, 18, 28, where 18 is the mean rate. At the time when GST was being introduced, there was a study committed at that point of time by the Chief Economic Advisor's Office on what should be the mean rate of taxation under GST. And there were various estimates which got exchanged. Finally, everybody said that from an economic fiscal perspective, it should be around 16% or so. And if you look at the rate that existed prior to that in respect of VAT and excise, majority of the products suffered 23%, 24%, 29%. Some products were at 18%, both combined. So 18% seemed to be a good rate at that point of time where majority of products would be taxed. But let's move on. We had this multiplicity of taxes. And what did this multiplicity of taxes do? It led to two situations. One, it made the tax environment in India exceedingly complex for anyone who wanted to invest in India or start a business in India. Some of you will also recollect that in respect of ease of doing business in India, where earlier India was at a rank of 140, over the past 4 years or so, we have moved from 140 and we have jumped to somewhere in the 60s. Among various other reasons, GST reform has also contributed to simplification of doing business in India. Because the taxes that we had prior to GST, whether it is VAT, central sales tax, purchase tax, entry tax, each state levying a cess on certain goods, these were dated 50, 60, 70 years back. So Central Sales Tax Act was a 1956 legislation. VAT, depending on when the state was formed, was 1961, 62, 64, etc. So doing business in 2017 with tax laws which were written 60, 70 years back and amended year after year was not a great way of doing business. That didn't put us, any one of us, in good light. Some of you may be interested in knowing that Central Excise Act, which was called Central Excise and Salt Act, is a 1944 Act. So which means this is a pre-independence act. Now this act was not originally intended to tax manufacture of goods in India. When it was introduced, it was intended to tax production of salt in India. Many of you will remember we had salt satyagraha by Gandhiji. So this act was passed in order to curb that, and then gradually this got expanded. So the question was, in 2017, did we really have a choice of going into GST? Could anyone have said, we'll continue with this for a few years more, then we will see? To my mind, all the erstwhile taxes, whether it is central excise tax, whether it is CST, whether it is a local VAT, all of these had crossed their shelf life or expiry date. Many of them should have been replaced many, many years ago. But fortunately for us, at least in 2017, we took the step of combining all these taxes and coming up with a GST. So what has happened in GST and how is GST played out, keeping the background? And I focus for some 8 minutes on the background so that we are able to connect the dots whenever we hear various things to do with GST today. And when people say GST is having that problem or this problem, let us take it in the right spirit and understand what is going on. First and foremost, the objective of GST was always to widen the taxpayer base. Because all of you will know that if the rates of taxes have to progressively come down, the only way of doing it is to collect the same amount of tax from a larger number of taxpayers. So unless the base of taxpayers is widened, it is very difficult to have tax rates that are reasonable. Unless the tax rates are reasonable, there will always be a scope for tax evasion and tax arbitrage. So the rate of tax always has to be a reasonable rate at which it is more beneficial to pay the tax rather than look for ways of means and not paying the tax. But to have a reasonable rate of tax, we have to widen the taxpayer base. So GST started on the principle that the GSTN number will be based on the PAN which is taken for income tax purposes. So the first 10 digits of the GSTN are even today the PAN. Now the moment the first 10 digits are the PAN, what happens is that it becomes very difficult to trace back a transaction and see whether the same transaction has been reported from the income tax side as well. The second aspect of GST, which was thought of even before it was introduced, is we wanted a tax which is completely automated from the beginning. The tax payment, the return filings, the refund processes, availment of input tax credit, everything has to be automated. It should not result in anybody having to go repeatedly to the tax office. And therefore, GST started out as a completely automated system. There have been a lot of challenges on the automation, especially in the first 2 years of GST. There were several challenges that everybody faced. The site did not work, the returns did not get filed, Tran 1 forms were extremely difficult to file. It was extremely difficult. But during that point of time, what the government did is while they tried to fix the challenges which were there, they also kept on giving more time to taxpayers to file the returns. As I said earlier, GST has certainly resulted in simplification of the compliance. While for manufacturers, it has certainly become simpler than what it was in the past. Because manufacturers, even in the past, were filing a monthly VAT return and a monthly central excise return. They were also filing a VAT return in every state where they operated. And that is what has continued in GST. The advantage for the manufacturers is earlier there were two separate pools of credit that they needed to operate. One for central excise purpose, one for VAT purposes. Now it is one fungible pool, which is used as a GST input tax credit pool. For service providers, compliance has become more complicated. It has not become simple. Because service providers were accustomed earlier to filing just 2 returns in a year. A service provider like a bank or insurance company could have one registration wherever their head office was located and use that to do business all across the country. Now they need to take registration in every single state. In every state, they need to file monthly returns. To that extent, it has become difficult. The GST Council, when it started, was a very difficult body to administer. But over a period of time, this body has been making multiple changes to the GST law. Whenever there is a situation which needs their attention, they have been at the forefront dealing with that situation. We also have large amount of transparency which has now come in. Now, this transparency has come in because the government would like to make more and more processes electronic. And if we have more and more electronic processes, it will be easier to grapple with all the compliances and all the other issues to do with GST. I will just move on in the interest of time. Now, the technology enhancement of GST has been one of the biggest achievements of GST. I would say that compared to the manner in which in income tax we have had the tracers platform, making it seamless for taxpayers to file their returns, look at their credits, decide what is the amount of tax to be paid, GST has done similar. One of the things GST has done is to ensure that the data flows very smoothly between the vendor and the buyer. Now, is this a perfect system? To my mind, even now, we have not achieved perfection. Many of the earlier challenges have been overcome, but even today, there are a lot of difficulties that people face when the supplier says he has uploaded an invoice and the buyer is not able to see the invoice. The vendor says he has paid the tax, but overall, the technology portal of GST has been improving month on month, year on year, and possibly in future, we will have a completely seamless system. E-invoicing was a very major objective that got realized in the last 1.5 years or so. Initially, when GST started, this was always proposed, but subsequently, because of the challenges that taxpayers faced, e-invoicing kept getting postponed. Now, e-invoicing is something which is intended for two purposes. One, when there is a seller of goods, there has to be a buyer of goods. And why don't we record the transaction simultaneously in both their books? It is similar to double entry system of accounting, where if you have a debit, you have to have a credit. The credit may go to a suspense account. But if there is a debit, there has to be a person who is credited. A debit cannot exist in isolation. Similarly, if there is a credit, it has reflected in a corresponding. A credit cannot come up in isolation. Same is the principle they have followed in e-invoicing. So when there is a seller of goods, there has to be a buyer because the term seller is used in reference to a particular buyer. There cannot be a person who says, look, I'm selling, but I don't have a buyer. Equally, we cannot have a buyer who says, look, I'm buying, but I don't know who the seller is. So that is what e-invoicing is intended to do, to reflect both sides of the transaction simultaneously. The benefit to the taxpayer of doing this is it makes their compliance and credit easier. The benefit to the government is that they are able to track GST frauds. They are able to see this where people have not actually supplied goods, but someone else has taken a credit. Similarly, someone has not actually bought the goods or has taken delivery of the goods or used the goods, but has taken input tax credit. They are able to track this also. But e-invoicing over a period of time was started with 500 crores. Then the turnover threshold got reduced progressively. And today, even with a low turnover threshold, it seems to be working quite well. In future, we should expect to see a situation where e-invoicing is mandatory for every single transaction in GST without any kind of threshold. So what is on the anvil as far as GST is concerned? Most of you would be aware that today we have a dynamic QR code for B2B supplies. We still do not have a dynamic QR. We are going to see a dynamic QR code for B2C to a very large extent. Traders and retailers are the people who are going to be significantly impacted by this. And traders and retailers will now need to upgrade their software in order to generate a dynamic QR code. Now, what will that lead to? Today, the transaction is being taxed for any product till it reaches a trader. Because it is only at a trader when a trader sells to a consumer that there is no input tax credit. All the preceding stages have an input tax credit, and therefore they are forming part of the GST system. But when a trader makes the final sale to a customer, that is not being tracked through a QR code. It is dependent on the voluntary reporting done by the trader or retailer. And if the trader retailer does not do a voluntary reporting, he has to be caught through a GST audit. There is no other way of tracking them. But in various other countries, there is a threshold beyond which all traders in respect of B2C supplies have to generate a dynamic QR code. So most traders in the European Union have to generate it for transactions above a certain threshold. That is what we are also coming to. Equally, what this might lead to is the fact that above a certain threshold in future, cash will not be accepted to settle transactions. We have a requirement today, but that requirement is from the income tax perspective, where cash transactions are not permitted beyond 2 lakhs. But that is an income tax requirement. That's not a GST requirement. It is quite possible in future that in GST, we have a requirement for a relatively low amount. Anything, for example, about 20,000. If you're buying from a GST registered dealer, GST registered dealer cannot accept cash for any transaction about 20,000. It has to be mandatorily a digital payment. This is again very similar to Europe, where they have a very low threshold in respect of transactions that they deal with, where they don't accept cash at all. GST audits are going to kick in big time now. And most of the people who had filed GST audit reports 9 and 9Cs for earlier years have now started getting notices for GST audits. Now they have undertaken a scrutiny of 9 and 9C. This has taken time for 2 reasons. One, because 9 and 9C, the dates were progressively extended. And the second aspect was that because of the pandemic, we had a lot of disruption in the country. Because of this, the GST audits have got extended. But over the last 1-2 months or so, we have seen quite a few companies getting GST audit notices. That is going to pick up big time now. And therefore, be prepared with all your reconciliations and all your data. In 2022, on June 30th, 2022, which is not too far off, it is something like 10 months away from now, we are going to hit 5 years of GST. And what is that going to lead to? The extended period of limitation in GST is 5 years. So if there is a show cause notice that has to be issued in respect of the transactions for 2017-18, ideally it should be issued over the next 10 months. They can, of course, go back and say that the calculation of the timeline is from the 9 and 9C submission date. It is not from the return filing date. But in many cases, taxpayers will also argue that it should be from the monthly return filing date, provided the returns have been filed in time. Vendor supply chain and ITC frauds, many of you would be reading in the media and in the press. This is something which unfortunately has increased and which is leading to a situation where the government has to tighten a lot of regulations. So we have seen the credits in respect of unmatched transactions progressively coming down. Long back, it was 20%, then it was reduced to 10%, and then it was reduced to 5%, and then to nothing. Now, why are we seeing this? This is only because there are a lot of people who seem to be passing on credit fraudulently. And the objective is to crack down on that and ensure that nobody trips the GST system. So what are the expectations that we have from the government as of now. I have listed down quite a few items, hence I will be sending the slide deck to Sharvani. So if any of you are interested, Sharvani will share the slide deck with you as well. But at a broad level, and they have been telling the government that you need to deal with these issues. Dealing with some of these issues has taken time because they are very intricate, complicated issues. Let me give you an illustration in respect of inverted duty structure. There are some products even now which suffer from an inverted duty structure, where the rate of tax on the inputs is more than the rate of tax on the outputs. That leads to the generation of an accumulated receivable called GST credits in the books of the sub are leading to the inverted duty structure in one industry are not used only in that industry. They are used in multiple industries. So if the rate of tax is reduced on those, it will lead to inverted duty structure in the supplying industry. Inverted duty structure are extremely difficult to deal with, and that is why these are taking time. But we expect that over the period of next 1 year or so, before we come to 5 years of GST, these issues will get addressed. We still do not have a GST appellate tribunal, which will be the equivalent of CSTAT. So any appellate authority passes an order, the appellate tribunal has not yet been constituted. Similarly, the National Authority for Advance Rulings was recommended in the union budget, but this has not yet been set up. So today, if there are two conflicting decisions by two advance ruling authorities in two states, two appellate bodies, against two AAAR decisions, there is no appellate forum where we can go to. Equally, if the same issue is recurring in multiple states, which state do we go to? That also gets addressed by the constitution of a National Authority for Advance Ruling. These are two bodies which are expected to be set up possibly over the next few months or so. So I'm at the end of my session and I will take maybe 2 minutes more. There are some hiccups on input tax credits and refunds. Some part of these hiccups are on account of the procedure not being clear. Some of them are on account of the fact that the pandemic has also impacted the tax authorities and they are taking time. But over a period of time, we have seen that refunds also gradually are getting streamlined. What is expected over the next 5 years? So the earlier slide that I indicated are issues that need to be taken up over the next few months. Here I'm just listing down some issues which have already taken up over the next few years. Petroleum products, of course, have to come under GST at some point of time. It may take a year more, it may take 3 years more, but at some stage it has to be coming. Similarly, the GST portal has to be made user-friendly for smaller businesses. Even today, the GST portal works pretty well. It should be made so simple that even a shopkeeper is capable of using it. Keep in mind that many shopkeepers over a period of time are very conversant today using various apps for their business. And there should not be any time limit for initiating the departmental audit. Because what happens today is because there is a time limit for initiating the audit, everything gets bunched up around the time limit is expiring. So ideally, there should be a time limit of 1 year or 1.5 years only for the revenue authorities to come back with any questions. If they don't come back with any questions in 12 months or 18 months after filing returns, the assessment is deemed to be closed. That is what will make it very, very simple. There is also a need to regulate the National Anti-Profiteering Authority. This was originally intended to be set up only during the initial period of GST. But this body has not prescribed any manner in which the methodology is to be arrived at. How do people go about computing the cost and pricing? How does one industry decide whether there is profiteering or not? this is something which is again expected and work in progress. I'm done with my deck. Any questions I'm happy to answer. Sharbani, I hope I was in time.
Yes, sir, and thank you, sir. So there is a question in the chat box from, I think it is from SR Royal. Am I correct?
Yes, yes.
Yes, so, sir, I'm reading the question. Will you please answer? We are
Yes,
into
please.
oil and gas business, which is out of purview of GST. Hence, we are unable to utilize ITC of input GST paid. We have to pay royalty to the government as well as head cost as per PSC signed with government. Now, there has been a levy of GST on royalty from January 19 by notification number 27 CTR. Damage huge rate is flat 10%, and gain is that it is entirely a cost, although paid under RCM. A Section 9 bench judge case is pending in case of MEDA to decide whether royalty is a tax. So how can they get relief on this? They have written a question, sir.
Okay. So, Mr. Chakravarti, it's a very complex question, and it is not only for you, it is for the entire oil and gas sector. Everybody is facing a similar challenge. But this requires a very focused representation to be made, both to the CBIC. Yeah, can I continue? Sharbani, can you hear me?
Yeah, I can hear you, sir.
Yeah. So this will get resolved. It is not, I do not think it is possible to resolve this through a court process. It has to be resolved by legislation, and it has to be resolved by the CBIC and GST Council.
Okay, sir. So can we till the time that this oil and gas comes under GST, can we think of paying this GST and royalty under protest? Is there any way to do that?
There is no mechanism in the GST law to pay any GST as protest. So the term payment under protest, which existed in excise, does not exist in GST. And therefore, you will not have that methodology available to you.
Okay, sir.
Okay. Anyone else wants to share a thought or a question?
Any questions from anyone, please? Sir, I request you to please forward me the presentations so that I can share with all the participants.
I will certainly do that, Sharbani.
Okay.
Okay, I think we are done, and we are just exactly at 30.
Okay. Any questions, please? So thank you, sir. And then we are moving towards for the next session. And we have a speaker from the department for the next technical.
Thank you very much.
Oh, thank you, sir. So we are proceeding.
Thank you very much.
Yes, sir. We are proceeding for the next technical session. We are having a speaker from the department. We are pleased to have Mr. N.C. Guria, Joint Commissioner, Commercial Taxes from Government of West Bengal. I request Mr. Guria to please deliberate on GST audit and litigation processes and share the departmental perspectives on these issues.
Thanks, Ma'am Shobani. Am I audible?
Yes, you are audible.
Okay. Thank you. Thanks to BCCA and I, and also my previous speaker, Mr. M.S. Mani, Honorable Co-Chairperson of Indirect Taxes Committee, the Bengal Chambers of Commerce and Industry, and the partner of Deloitte India. And my gratitude to Mr. Timir Baran Chatterjee, Honorable Chairperson of Indirect Taxes Committee, the Bengal Chambers of Commerce. And actually from the beginning of this session, I heard the deliberation of both the speakers, eminent speakers, and I must thank both of them for their lucid deliberation. And also my thanks to especially Mr. M.S. Mani for raising some disputed questions, which are really the attentions are needed, and that area, and the stakeholder also should be very cautious on that part. And the deliberation of the Mr. Timir Baran Chatterjee was so lucid, and he discussed a very tough topics in a very simple manner. That is the capability of him. So I am asked to deliberate on the issue of GST audit and the audit by the department and the state government perspectives on that. So, Madam Sarmani, if you allow me to share my screen, it will be better for me to convey it.
But the co-host also.
Yes, I can. No?
Yeah, you can share.
Is it viewable now?
Yes,
Visible?
we can view the screen.
Okay, thank you. So, thanks to BCCI again for giving the opportunity to present these topics before the stakeholders, which is crucial for the state also, because we are going to start the GST audit very soon. Now, for GST audit, basically what Mr. Mani said that, there is no time to start that audit, neither there is any end time to end this audit process. That is true. But, in the question of the outcome of the audit, that end with the demand recovery proceeding, basically. So there is time limit for that demand and recovery proceedings, that is,
So,
if the taxpayer, yes.
Will you please increase the volume?
Okay. Is it okay now? Hello?
A little bit more.
Okay.
But
is it okay?
Yeah.
Okay. So in that case, if the proceeding is under section 73 or under section 74, in that case, the time limit is 3 years or 5 years from the due date of submission of annual return. So for the year of 18, the due date was extended up to 7th February 2020. So basically, to raise the demand under section 73, there is the time limit up to 6th February 2023. And for proceedings under section 74, another 2 years are also there. So basically, it's not our motto to bring this audit process end up with any litigation that Mr. Chatterjee. So today we'll focus basically how we can minimize the litigation. So my presentation plan is like this. Now I would give some brief idea of what is the difference between pre-GST audit and GST audit. What is the provision in nutshell? And what will be the probable audit flow chart for the taxpayer under the state of West Bengal, and how the selection procedure is going on, how that will be, examination will be conducted by the audit officers, and how the discrepancy will be communicated. And finally, after the basis of the final audit report, if the auditee is not satisfied with the final audit report, how the litigation will be there, and who will be the officers who will deal with that litigation process. So first, there is 3 types of audit in GST. One is, turnover-based audit. That is subsection 5 of section 35 speaks that if the turnover, aggregate turnover of any taxpayer exceeds the prescribed quantum, in that case, that will be audited by chartered accountant or cost accountant. That is basically the turnover-based audit. And along with that, there is 9C is also required to submit it. That is the reconciliation statement. And there is another audit, that is special audit, that is also conducted by chartered accountant or cost accountant, that is under section 66. That is basically the needs by the tax officials in the course of any examination, scrutiny, verification, also in the course of audit, if he feels that the process is so complicated that the help of any expert agency, that is of chartered or cost accountant empaneled, is required, he can bring that case before the commissioner, and the commissioner appoint any of these empaneled chartered accountant or cost accountant for conduct that special audit. And the last one is that audit by the tax authority. So that is as per section 65, and the rule is there in 101 of CGST or WBGST rules. So it is basically the audit by the tax authorities. So in this webinar, basically we will focus on that audit by the tax authorities. Now, what was the pre-GST audit? You know, in under Finance Act and also under WB VAT Act, audit were conducted. So in that case of Finance Act, the audit are conducted on selected assessees only, and the guidelines they published in the form of SESTAM, that is Central Excise and Service Tax Audit Manual. And you know, in case of non-compliance, the Audit Commissionerate, they are used to send the files to the Jurisdictional Commissionerate to raise the demand and recovery proceedings. So basically, this idea is captured in GST audit also. And under VAT Act, you know, before, basically I am talking about the West Bengal VAT Act. So before 1st April 2012, that is up to 2011-12, the process was that first the selected taxpayer will be audited by the audit team, and after that the audit report will be forwarded to the jurisdictional officer for raising assessment procedures. So basically it was a repetition of same work. So therefore from 1st April 2012, there was an amendment in West Bengal VAT Act that after a stipulated time, the audit report will automatically transfer into the assessment order, so that the taxpayer or the auditee, he can file appeal before the appellate authority if he is not satisfied with the audit report. So in GST, basically we are going back to the repetition of the same work. So, but in this point, my request to all the eminent participants, that those who are engaged in the business and those who will be selected for audit, that please, if we agree that we can, it is our motto to minimize our litigation procedure. So both the tax authorities and the taxpayer, they can change their view, because you know, it was a common complaint from both the part of the taxpayer and from the part of the tax officials that the tax official is not going through all the documents which were placed before him, and arbitrarily he has raised the demand. And at the same time, it was a complaint from the tax official that in spite of asking several times, the auditee is not producing the books of accounts. So with this, you know, this different types of view of both from the part of the taxpayer and tax officials. So I just want to request you, please, those who are in the opinion that if you produce the books of account before the audit authority, it will be fatal for you. That is not true, because in this year we have published our West Bengal audit manual, GST audit manual, and in that audit manual, our commissioner was involved deeply, so no taxpayer can be harassed or there should not be any complaint which was the pain which is exist in your mind. So audit by the tax authority, what is the section 65? You know, the commissioner may select any taxpayer for audit for a financial year or part thereof or multiple thereof. But it is not the question of that the commissioner will select as his will any taxpayer. So there will be a selection procedure. And I will discuss in brief what is the selection procedure. And second is that after the selection, you know that the auditee will be allowed at least 15 working days prior to conduct of that audit to prepare his books of accounts. And after the commencement of audit, within the 3 months, the audit shall be completed. So, but what is the commencement here means? Because you know, in the VAT Act, the date of selection is treated as the commencement, but in GST, the commencement of audit is that when you produces the books of accounts before the tax official, or the tax officials, they start examining your books of accounts at your business place, which one is later. So basically, it's again the request to the taxpayer. So don't request to make another date or asking for adjournment to defer your commencement of audit. Actually, it will be fatal for you, because the last date you will be allowed to complete your audit, because all the audit officer, they are allowed with certain numbers of files. So the number of days allotted for you will be minimum in that case. So please start at the date fixed in the ADT 1, and after that you request your audit officers according to your convenience. So in this point of view, I can give you one input to you that in case of that central tax authorities, in their audit manual, they mention that for the large taxpayer unit, it is only the 6 to 8 working days is allotted to complete one audit. And for medium scale of business, it is 4 to 8 working days. And for the small, it is 2 to 4 working days. But in our audit manual, we have not mentioned such a fixed date, but you know, it is not like the VAT audit that your audit start today and you just come with an application that please allow 3 month time or 1 month time because we are busy this for the this one. So it is not like that. It is different. It is not, because in VAT Act that was 1 year time to complete your audit, and different types of forms, declaration forms, certificates was required to produce before the audit authorities. But you know, in GST there is no such declaration form or certificate. So in that, hello. So hello. Any problem over there? Hello, ma'am Sharbani, if you please.
Please unmute yourself. I think there is some problem.
No, madam, no.
Hello.
Sir, पूरा नेट का issue है.
Shall I continue?
Yes, please continue.
Oh, thank you. So,
okay, sir.
After the commencement, 3 months. There is
God.
Now,
Yes.
hello.
Yeah, we can hear you now. We were muted.
So what is the audit flow chart now? Audit flow chart in case of the taxpayer visibly audited by the state authorities. It is basically the 6 steps. First is the
Again.
already unmuted. Okay. So, there is audit plan. And again, there is after the audit plan, the examination will be carried on. And what is the process of examination? We will discuss that. After that, the discrepancy will be communicated to the taxpayer. And after that, the final audit report will be communicated. So what is the needs of this audit plan? And there is draft audit plan, audit report before passing the final audit report. So audit plan and draft audit report both are basically for the department itself, not for the taxpayer, but it will be helpful to the taxpayer, because in case of audit plan, every audit officer, they are bound to place a audit plan before his higher authorities. Now, it will minimize, I think, the unnecessary raising the demand or unnecessarily asking the documents which is not at all required for the audit process. Suppose in case of audit of a taxpayer, which is engaged in basically in exempted supplies. So suppose a hospital industry. So in that case, it may be 80 to 90% or 70% of its turnover is exempt turnover. So audit officer may focus on that exempted turnover, and he may ask all the exempted supply related documents, everything. But the experienced higher officer will ask, why you are asking all these exempted supply related documents? Is there any adverse report with you, or is there any other findings with you? So it is not his will that he can ask any documents to the taxpayer. So before conducting audit, he is bound to explain before his higher authority that why he is asking all these documents to the auditee and what is his plan of audit. If the higher authority is satisfied, then the audit plan will be sanctioned and he can start that audit. So after before issuing that final audit report also, the same procedure is there, that one draft audit report should be placed before the higher authority, and he will find that whether there is any paper demand or book demand or unnecessary higher demand having raised for the taxpayer. So I think all the eminent participants over here, they will be pleased to hear that this type of audit plan and draft audit report, which will be a great relief instrument to them in future, is placed in an audit manual, specifically in West Bengal audit manual in GST. So now, what is the selection procedure in case of audit in West Bengal? It basically based on that potential high risk parameter. Basically, the risk parameters are divided in 6 areas. One is turnover, tax, ITC, refund, sectoral study, and non-compliance. I'm giving some examples. Say in case of, risk areas related to entity level risk parameters. Which are those entity level risk parameters? That is the turnover, tax, ITC, refund, evasion prone goods and services, etc. Next is that risk associated with compliance behavior. That is late filer of return, non-submission of return, non-submission of return in Form 1, 3V, 9, 9C, etc. And risk based on various ratios, such as taxable turnover to exempted turnover, output tax to input tax ratio, cash payment to output tax ratio. These are different types of ratios are there. Based on that, risk score will be calculated. Now there is risk based on exceptional report. Which are those exceptional report? Say ITC claim in the audit period in form GSTR 3B versus ITC auto-populated in GSTR 2A. Turnover declared in form GSTR 3B versus form in GSTR 1. Claim of ITC from cancelled RTP, etc. These are the some examples of risk based on exceptional report. Next, risk based on pre-GST history. It's basically the excess ITC claimed in the last return under VAT Act versus SGST credit claimed in Tran 1 and Tran 2, potential evader of pre-GST regime, and some other criteria which maybe the selection committee may deem to fit. So these are the, in nutshell, the selection criteria, and there will be the scoring for each of these criteria, and the minimum score is 1 and the highest score is 5. So the selection committee formed by the commissioner, they will identify the risk parameters which are I just discussed, and weightage of each parameter, they may vary depending upon the importance. And finally, the risk score of each parameter that will be added, and that will be the final score. And on the basis of the final score, the taxpayer will be selected for audit. But it is not the motto to select the more percentage of taxpayer from the lower turnover group. So basically, there will be 3 segments based on the turnover. One is that the higher turnover group, middle turnover group, and the lesser, the lower turnover group. So it is desired by the commissioner that the percentage of selection from the lower turnover group will be minimum. And there may be a random selection of 10% on the basis of specific report. So now we are coming to the very important area, that is, that is production of books of accounts. So in case of production of books of accounts, you may remember your past experience that in VAT audit, the officer is used to ask all the books of accounts on the first day. So, but it is very difficult for both the taxpayer and the tax official to examine all such documents on a very first day of audit. And it is also very difficult for the taxpayer to produce all such documents on the very first day. So from the experience of that VAT audit, so in the VAT audit manual, our commissioner is fixed that some criteria to produce the books of accounts. So that may be asked by your audit officer in a staggered manner, so that you can also easily produce that, and the officer also can verify on that particular date. So which are those books of accounts? Those may be asked by your audit officer. Now, on the first day, your audit officer may ask these 5 types of documents. One is your annual report or a director's report. Second, your profit and loss account and balance sheet. Third is, trial balance. Those who have multiple GSTN, that is GSTN in other states also. But those who have already submitted 9C, I think this trial balance is not required for them. And fourth is, consolidated party-wise yearly statement of your inward and outward supplies. Last is your reconciliation statement in respect of turnover and ITC with regard to GSTR 3B and GSTR 1 or GSTR 2A. So these are the 5 types of documents which your tax official or the audit officer may ask from the first day of your audit. So please prepare all these books of accounts and prepare all the statements, those who will be selected for audit, to produce before the audit officer on the very first day. And on the basis of this, all the documents, the audit officer will proceed for audit. And the future course of actions definitely depends on these findings drawn from all these five types of documents. So now, with this ADT 01, the officer may send a questionnaire to the RTP on that particular date to produce with ADT 1. You know that questionnaire is very simple questionnaire. I am giving one example. Say whether you are maintaining different series of invoices. If you are maintaining different series, so please mention the prefix of suffix of such series, and you mention the first issued number of that invoice and the last number of that invoice of every series. This type of questionnaire may be there. So it will help both the auditee and auditor to complete the audit process in a very focused and planned manner. So it is not burden to the auditee. It is basically will be helpful for the auditee and the audit officer. So now how the examination will be conducted. In case of examination, if you go through the definition of audit, if you go to the subsection 13 of section 2 of CGST or GST Act, audit in GST means detailed examination of records, returns, and other documents to verify the correctness of, what is that correctness? That is turnover declared, taxes paid, refund claim, ITC availed, and assessment of compliance with the provisions of the Act or the rules made thereunder. Now, the taxpayer may ask, what is that assessment of compliance with the provisions of the Act? Is it necessary to verify in the audit process all the compliance of the Act? It is not practical. So I'm giving an example. So how the assessment of the compliance with the provisions of the Act may be verified by your audit officer. So the example of compliances is like that: maintenance of your books of accounts, time and place of supply, value of supply, tax rate changes related compliance, RCM related compliance, and compliance related your reference circular, clarification, order of advance authorities, or any code order, etc. So these are basically the area where the compliance may be examined by your audit officers. So now, say for example, invoice compliance. In case of say invoice compliances, suppose there is a missing number or by number. So there, please prepare your reasons why there is reputation of the same invoice number or by number or missing number, and give the actual fact with supporting document. So now I'm coming with one example of maintenance of books of accounts. You know, in case of that auditing standard and accounting standard, sorry, and in the vis-a-vis GST, there is some, there may be difference. For example, a contractor received mobilization advance of rupees 50 lakhs in the year 17-18, you know. Now, as per the GST law, time of supply is, that will be in 28th August 2017. So it will be part of your GST revenue. Now, the question is that it is not the revenue as per your books of accounts, because you know, this particular, in case of this mobilization advance, it is adjusted against a running account bill dated on 30th August 2018. So that is in the next financial year. So though as per the time of supply, Ma'am Sharmani, please, lots of noise is coming.
Yes, I have muted them.
But
Please,
uh, actually, the names are also displaying over here. Those who are speaking. So if you please request them, please, one second.
please mute yourselves.
Okay, so all the participants are requested, please mute yourselves so that we can conduct this session. So again, I am coming back to my session that though the mobilization advance has been raised in 28 August 2017, but RA bill, running account bill has been issued on the 30th August 2018. So as per your books of accounts, that is not revenue in 17-18 for this mobilization advances. So there is a tussle of this revenue as per your books of accounts, and that's as per your GST. In GST, that is the definitely the revenue, but in your books of accounts, this 15 lakhs will be in the liability ledger. So prepare all these things where there is a contradiction between the turnover as per your books of accounts and as per the GST norm, and because your audit officer may ask this area. Now, the audit officer will be very focused on the other income ledger, because it is a very it is the area which is important both in the VAT regime also and also in GST regime. So in other income area, there are income maybe recovery from employees for transport charges, mobile expenses, notice pay, canteen expenses, interest income, profit on sale of assets, reimbursement income, etc. But when you are preparing all these documents, or please be prepared with the argument that when there is a reimbursement between employee and employer, be prepared with your argument that if you not booked that part in your GST revenue, then please prepare with the argument that this is basically that. Please, 1 minute. Yes, sir. স্যার ওই সেমিনারে আছি, বেরিয়ে করবো স্যার, সেমিনারে রয়েছে ওই ওয়েবনারে। ওকে স্যার। So basically reimbursement is subject to GST only if it can be established that these are made towards provision of goods or service and other than the services by employee to the employer in ordinary course of employment. Because in the first entry of Schedule 3, it speaks that the services by the employee to the employer in the ordinary course of his employment is neither to be treated as supply of goods or service. So please prepare your argument in that manner, and that reimbursement that should qualify as a consideration if the officer wants to treat it as the GST revenue. But all reimbursement are not in the nature of consideration. So prepare your argument that if some reimbursement is not in the nature of GST revenue, then you should establish that it is basically the services provided by the employee to the employer, and the reimbursement is not in the nature of that consideration. So these are some area I just discussed. So officer may ask also in that area, in case of that company, there are some non-executive directors, and there are some directors who are basically employee of the company, and some directors who are not as employee of the company. So in that case, their sitting fee, that is reverse charge as applicable on that part. But apart from the sitting fee, you may facilitate him with some club facilities, with some car facilities, or any other facility. So in that case, that also will be the part of your valuation, because in case of that service provided, that non-executive director to the company, only not the sitting fee as the consideration. There are considerations both in money and kind. So therefore valuation rules 27 will be applicable. So value of supply will be that sitting fee plus club expenses and other such expenses. So please prepare your books of accounts in that manner. And last is the communications of discrepancy found. You know, in case of this audit, there will be different audit para will be there. So different types of audit para which are based on some, some nature of observation. So if the nature of observation in respect of your turnover, that may be on your ITC, that may be on your, that is any mismatch of your 2A versus 3B. So all these types of audits paras will be communicated to you. If you find that some para, if you admit to accept that paras, please accept that and pay that voluntarily in DRC 07. It will basically minimize your litigation procedure. So after receiving that discrepancy within 7 working days, please reply. And after considering your reply, that draft audit report will be prepared and placed before the higher authority. And after the consent of the higher authority, the final audit report will be placed before you. And if you want to accept that final audit report fully, in that case, the audit will be concluded and no further action will be there. And if you admit partly, or if you don't want to admit at all, in both the cases, it will be referred to the adjudicating authority for initiating demand and recovery proceeding. So the litigation begins from that part. So it's my request to all that if you feel that no, there is argument in favor of you, so please place that written argument with supporting document before passing that final audit report, so that that can be explained before passing that final audit report. And if it is not, in that case, the audit officer also will communicate you why your argument is not accepted by him. So in that case, you can also file in your next forum when the demand procedures will be initiated. So basically, this is the process of audit over here. But 5 things you should remember, that COPERT is the audit team and procedure of books of accounts asked for. Basically, why I mentioned these 5 different things to remember, because it will basically minimize your litigation. COPERT the audit team and produce books of accounts as asked for. Try to answer with supporting documents in the course of hearing. And if any findings appears admissible, make payment instantly, not to increase interest burden. 4th is that submit replies in respect of discrepancies communicated timely, because once the final audit report is placed, so audit officer will not be in position to accept your replies. Now make voluntary payment if all or some of the audit paras appears acceptable. So basically, it will basically increase your compliance level and also decrease your future tax burden. And that is all about today's topics. Thank you very much. Madam, definitely I have ended with my time.
Thank you, sir.
Okay, thank you very much.
Any questions? Any questions, please? If you have any questions, you may check.
No, madam. No, madam. No, madam.
Okay, then I request Mr. Guria to please share the presentation with us so that we can forward it to the participants.
Okay, okay. I will.
So you have my mail ID. You please share the
sure.
presentation.
Definitely. Sure.
Okay, so we are closing the session today. So if there are no questions, thank you all for joining today. Today's session. We will forward you all the questions and the present link.
Ma'am,
Yes, please.
मैम 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 वो जो आपका जो प्रेजेंटेशन होता है वो मिल जाएगा?
Presentation, yes, yes. We will share the
Okay.
presentations. Once we get it from the speakers, we will share the presentations. Also, the recording of the program, we will share in a YouTube link for your future reference.
Thank you, ma'am.
In a day or two, we will share the full recording of the program.
Okay, thank you, ma'am. Thank you.
The full recording of the program as well as the presentation.
Okay, ma'am. Okay.
So thank you all for joining today. Thank you very
Thank
much.
you, thank you, thank
We
you.
will have more sessions in the coming days, and we request for your participation and support. Thank you, Mr. Guria, once again.
Thank you.
Thank
you
you
very much.
Thank you, sir. Thank you, ma'am.